Hi, my name's Jared Broad with QuantConnect, and in this screencast we're going to look at how position sizing can influence the returns on your account. We're going to use a popular gambling technique called Martingale, where you double down on your losses, and we're going to use the relative strength index to decide when we enter the market. We're going to code this up from scratch and then review our results and look at ways that we could possibly improve the strategy. So let's get started. Position sizing is important to moderate the risk that your portfolio is exposed to on any particular trade. You can use the strength of the signal or the volatility of the market or the overall balance of your portfolio to decide how much of your cash you should allocate. By deciding to minimize the cash possible or maximize the cash when you have a strong signal, you can affect the returns on your position. One such popular but risky position sizing technique is actually called Martingale and originated in 18th century France. Gamblers would bet on a game of heads and tails, and if they lost, they would double their bet and continue gambling. Eventually, when they won, they would make back all their losses. We can use this technique and apply it to trading. If we're losing a trade and we're long, we will double and go short. And conversely, if we're short and losing a trade, we'll double and go long. And we'll hope that the movement, the momentum in the market will eventually bring us back to break even. If we continue to lose in the opposite direction, we'll flip again until we win and break even. This is a very popular but very risky strategy, and most of the time Martingale strategies look fantastic. They're a perfectly straight line right up until they explode. Just in a quick review on why position sizing is important and how you can apply the Martingale betting strategy to your portfolio. So now we want to do a quick design overview to how we could potentially design this strategy before we jump into the coding. There are more sophisticated ways to lay out your algorithm structure, but for now we're going to continue as if it's just a script. First, we're going to scan if we don't have any stock and then look for an entry into the market. The particular entry mechanism doesn't really matter at this point because we're just investigating our position sizing and how that affects our returns. Once we have an entry and we hold some assets, we're invested, we're going to scan to see if our profits meet the minimum criteria. Then, if we do meet the minimum criteria, we'll take our profits and exit the market. Or, if our losses exceed our maximum losses, we'll invert our holdings and go the opposite direction. Again, the exact mechanism for inverting our position or taking our profits, we haven't determined at this point because we're just looking to demonstrate Martingale. To kick off, we're just going to clone the basic template, which you can find in the Starter Algorithms section. Now we have the algorithm cloned and imported into our profile, and we can just delete some of the unnecessary placeholders from the basic template and implement the pseudocode that we just described before. To follow the Martingale system, if we're not invested, then we want to scan for entry into the market. Or if we are invested, if the profit's greater than the minimum profit, then we can scan for exit. Or conversely, if our profit is less than our maximum loss, then we have to do the Martingale flip to double and invert our holdings. That means to go from long to short or short to long, and also double the amount of shares that we're investing for as long as we can. So at the moment, this is just pseudocode. We haven't written any of these yet. If you wanted, you could skip this and clone the algorithm, which is attached to this tutorial, which has written it all for you, and then you can just learn from the pre-written strategy. From here, we can start filling out the algorithm, how we would like it to behave. We could start with this pseudocode for not invested. The equivalent in the QuantConnect API is portfolio hold stock. If we don't hold any stock, then we have to scan for entry. Otherwise, if we do hold stock, then we can scan for the profit and loss levels. Profit is also easily accessible from the QuantConnect API, from the portfolio.total unrealized profit. And then we've also written two routines here, scan for entry, scan for exit. Three routines and flip. Those three routines will form the basis of our Martingale implementation, and we can lay out those functions here. We haven't really thought through what exactly is going to go into these yet, but we're just following our pseudocode design so far. Now we have our profit, which we've extracted from the API. We have our whether or not we're invested. again from the API. And now we have this maximum loss and minimum profit reading that we haven't determined yet. We can set these to be fixed or variable, but just for the moment, for simplicity, we'll make them a fixed number, a fixed percentage, so that way we can adjust it later and maybe even make them variable based on different market conditions. So for now, let's determine these parameters for our strategy. We'll define these in a public space. These are essentially algorithm settings. The minimum profit and maximum loss will affect how our algorithm performs in different markets. For example, if we targeted a tiny minimum profit, we're more or less guaranteed to achieve it. And if we set a very large maximum loss, it will increase the win rate for our strategy. Because these are parameters, we need to try and minimize the use of parameters where possible. The more parameters you have in your strategy, generally, the more likely you are to be curve fitting. We're going to set this to be 2% target profit, and we add this M character onto the M because it's a decimal variable. The M stands for money in this sense. Decimal is a C# type, which is especially made for money because it doesn't induce any rounding errors. If you use a double, which is typical in other languages, then they tend to round off the fractions of a cent, which you can't accept for an algorithmic strategy. Our target profit is 2% there, and we'll make our maximum loss as 3%. Again, we need to put the M there to signify a decimal number. So now we've set our target profit and our maximum loss as percentages, and we have this profit figure, which is a cash number, which is taken from our API. It's probably easier if we abstract these away so that we can simplify our main routine. Also, because we hold stock here and we've scanned for entry, if we put return here, it will exit the strategy until we have stock. So then we'll never reach this next section of code unless we're holding some stock. So to simplify it again, we can remove that and just put it here. So now let's abstract away this figure here where our profit is greater than our minimum profit target, or in this case our target profit is what we're trying to achieve. So let's make this a property. C# is great that you can just define these properties which allow you to abstract away certain characteristics of your algorithm. For example, here we can make a new Boolean variable that the minimum profit has been achieved, and then if the minimum profit has been achieved, then we'll scan for exit. So this Boolean will return a true or false, and we need to get the value that we want it to return. We can return if the portfolio, the total unrealized profit, divided by our portfolio cash, if that is greater than our target profit, then we've reached our minimum 2% target profit, and it will return true. One of the key characteristics with Martingale is that you want to try and recoup the losses of your previous trades where you've doubled down. In this case, the portfolio total unrealized profit has no memory of any previous trades where we've gone wrong. And at the moment, we haven't done any incorrect trades, just the data has come in. We have determined whether or not we've got any stock. We've scanned for entry. And then if we reach the minimum profit, we exit. The next section is when we'll flip the algorithm. We'll change from long to short. And then that's when we'll incur a loss. If the loss in this case is greater than our maximum loss, then we'll invert the holdings. We'll come back to this later once we're ready to remember our previous losses. For now, we will just deal with the scanning for entry. Scanning for entry is fairly arbitrary in this sense. We're not looking to demonstrate a new entry technique. We're looking to demonstrate the Martingale position sizing, and you can use any sort of entry technique that you want. But for this demonstration, we're going to use the relative strength index. If you go to the left and look in the code library, you'll see the relative strength index code snippet here, and you can just click on that and it'll import it to your profile. This adds the relative strength index code here, and you can review this later, but essentially it should be plug and play. It should just work immediately. The class is called the relative strength index, and we can use that in our algorithm. Before we use the relative strength code in our algorithm, I wanted to give you a brief explanation about what it is. The RSI is a popular technical indicator to measure the rate of price change of the market. It's said to be able to detect whether or not the market is oversold or overbought. In general, these technical indicators are very well known, and what's generally well known loses its advantage in the market. Possibly you could customize it and make it your own. These levels, which indicate overbought and oversold, are typically 70 and 30. When the RSI indicator falls below 30, it's said to be oversold. And when it goes above 70, it's said to be overbought. So if you short when it's overbought, then it's a good chance that it's going to fall. We're using this as a fairly arbitrary entry technique because we're more interested in demonstrating the Martingale position sizing. To use the relative strength index in our code, we're going to declare an instance of it in the public space here with the period 14. In this case, 14 signifies 14 trade bars because we're requesting minute level data. We're going to use the symbol string again here and define SPY so that we're trading on the index, and then every minute we'll get a new trade bar. The RSI needs this new data, so we're going to take the SPY trade bar and then add it to the RSI. This way our RSI gets updated every minute with new trade bar data. To use the RSI, it has a ready flag which we can use to detect when the RSI is ready to be used for trading. Inside our scan for entry system, we're going to go RSI.ready to detect if it's ready, and then use the RSI values to detect whether we should go long or short. In this case, we're going to be flipping back and forth between long and short. So keeping track of the orders and our holdings and the exact order quantity might be more effort than it's worth. So we can use another helper class so that we can set the holdings as a whole number. So for example, if we use set holdings 1, that will signify we want to go 100% long. If we use set holdings -1, it will signify we want to go 100% short. Also, if we set holdings to +2, it would mean that we want to go 200% long. This will be the first tutorial where we're using leverage. Martingale is a fairly leverage intensive strategy which requires you to go beyond the cash that you typically have. In normal equities trading, you have up to 4 times leverage, so we'll use 4 times leverage in this strategy. We can define our leverage as another publicly accessible variable because we'll possibly need to use it later. In this case, we'll set it to a realistic 4 times leverage. To set our leverage, we can update it on an equity symbol by symbol basis. You can see the full description of Add Security. If you go to GitHub, which you can access through the top bar here, you can go to the underlying code and see how this functions and those extra 2 parameters. With this, we've set our leverage to be up to 4 times, so we can use up to 4 times our cash in our strategy. We're going to use the set holdings helper method I described before, and you can access this again in the code library and then the set holdings class here. Click the import button to import the set holdings code to your strategy, where you can use it to set your holdings fractionally. So for example, set holdings of Apple to 0.1 would set it to 10% of your cash to Apple. The public partial class here signifies that this function will be accessible inside your main routine as long as the name is the same. So here we have it as the same because we made this for this tutorial. But for your code, you'll probably want to change this name to be the same name as the class of your algorithm. This partial class signifier means that you can break up this one file into multiple smaller files, which makes it easier to code. Now we're able to set our holdings fractionally. We can go down here, and when we get the RSI signal to enter, we can go long and go short fractionally. To control these fractions, we're going to create a new variable called magnitude direction, which is going to keep track of how much we're going to invest and the current direction that we want to point. For example, long would be positive and short would be negative. In the case where we're exiting, we want the magnitude direction to reset. In the case where we're flipping, we want the magnitude direction to multiply by 2 and -2. So now this will reset when we take a profit, or double down and flip the direction when we have a martingale flip. When we exit, we also want to liquidate our holdings and remember the date that we quit. We'll create a publicly accessible magnitude direction and also a public record of the exit date. We might want to record the exit date so we can ensure the algorithm doesn't go crazy on bad days. The exit date might, for example, increase the algorithm efficiency by ensuring it only trades on strong signals, and on days where it's flipping back and forth, we don't want it to trade at all. When we do a flip, we also want to record the exit date. For each of these numbers, we should use the M signifier because magnitude direction is a decimal. Let's implement the exit date first so that we don't want to trade again if we've exited today. If we don't hold any stock, before we even scan for entry, if the exit date is equal to today, then we want to quit immediately. And only look to invest when it's not the same date that we just traded. To make controlling our entry easier, we should write a handler for the magnitude direction. We could write a function here which accepts a multiplier to apply to our magnitude and direction. Our magnitude and direction has to be normalized. For example, we only have 4 times leverage, so if the multiplier means that we would go over 4 times leverage, then we need to ensure that our holdings don't try and buy more stock than we can handle. So here we're going to apply the magnitude direction is equal to the magnitude direction times the multiplier. And now to normalize it, we'll check if the magnitude direction has gone out of bounds of reality. Now we have this helper routine which normalizes our values for us. We can go to our flipping controller, which inverts our holdings when we have a martingale loss, and use it to set here. And that will handle all the normalization for us. Once we've set the new multiplier, we want to set the holdings to the new magnitude and direction. So our multiplier has been flipped. We've saved the exit date, and now we are going to set the holdings to the new magnitude and direction. For example, before we were long 1 and we apply the multiplier, so now it's -2 for the magnitude and direction variable. And so then the set holdings will set us to 200% short of the SPY. At this point, we can actually record the loss that we incurred before we flipped the strategy. We make a new variable called the trade string profit, which saves the unrealized profit, or in this case, loss. This trade string profit will be our running total of losses that we'll use to try and get back to break even. We'll just fix bugs. And now we can define this trade string profit as another working variable to keep track of the total losses. When we're looking to see if our minimum profit has been achieved, we could add this here. So the trade string is our string of losses plus our current unrealized profit divided by our cash. This way, our minimum profit won't be achieved until this trade string losses plus the unrealized profit has been equalized. When we have a win, we need to reset this in the set exit. This way we're recording going back to break even. The only thing left to do is check to see if our losses have exceeded the maximum loss that we're allowed for this strategy. Because we're investing a variable number of shares, it would be helpful if we could measure the maximum loss per share. So here we can take the price of the share minus the average price and see if that value has exceeded the maximum allowed value. Because this is going to be a long and short strategy, we need to measure the absolute. If the price does exceed this maximum loss per share, then we'll do our flip. This maximum loss per share we can define as a new property. Our maximum loss per share will use our maximum loss allowed percentage and then use our absolute holdings to get a cash figure. The cash loss will be equal to the maximum loss percentage times our holdings. Now we have a cash figure, we can return the actual loss per share that we'll allow. So we take our cash loss divided by the number of shares we have. This will return, for example, $1 loss is allowed on a $100 SPY share. So this will take our current stock price and find the difference with our holdings, and if that difference is greater than our maximum loss, to invert the holdings. We only want to flip if we're negative though, so we should check to see if our unrealized profit is negative. This price variable we haven't defined yet, but price is just the SPY closing value. And now we're ready for our backtest. After running this strategy, we found that it actually didn't make any trades at all. And so if we go back to the code, we see that the default magnitude direction here was 0. And so when it went to set to scan for entry, it wasn't buying anything. So if we set this to 0.2, it sets the minimum entry as 20% of our cash. Now similarly, if once we go to scan for exit and it liquidates, we should probably return here so that it doesn't run any more of our code. And also when we exit, we probably want to reset the trade string parameter here so that the minimum profit can be achieved for the next round. To skip this and jump straight to the nicely commented one, I recommend cloning the algorithm associated with this tutorial. After debugging the strategy or cloning the tutorial template, you can run a full backtest on the full 15-year data set, and you'll get something like this, where you'll see the strategy does beat the S&P 500, although it has periods of intense volatility. So here, for example, in the end of 2011, November, the strategy collapses roughly 20 or 30% within a month. This phenomenal volatility is very characteristic of Martingale, as we saw at the beginning, where it has a nice smooth line beating the market right up until it crashes. One thing that's interesting is that we don't see the characteristic instant rebound of Martingale. In order to get that perfectly straight line that you see on Martingale strategies, you need near infinite leverage in cash. With our limited resources and 4 times leverage, we weren't able to rebound immediately, and so it took most of 2012 and 13 to rebound to the prior highs. There's a number of ways that we can improve this strategy, and they're definitely worth further exploration. So for example, we could use actually smart entry and exit techniques, which we don't at the moment. Exactly what entry techniques I'll leave up to you. And similarly, the profit and loss targets are very critical for this strategy, because if you set lower profit targets, you can increase your win rate. But that's a warning sign when you design these strategies. So potentially you could make the profit and loss targets dependent on the market's volatility. So if the market is very volatile, you could set lower targets that'll be easier to achieve. Or if the market is nice and smooth, maybe you can increase the targets so that you can take more profits when it's available. You might want to measure the number of trades that the strategy is doing. In 2007, if we have a look at the actual stock plot, by clicking on the side bar here, you can see that we're doing a lot of trades at the very bottom of the market. And typically this means that your strategy isn't being very efficient. While it's doing a lot of trades, it's incurring a lot of slippage and a lot of trade fees, and it's probably not behaving as you would expect during these volatile and turbulent times. You can actually see that the very peak here is one of the greatest periods of loss in the algorithm, and it also coincides with one of the highly volatile, the rapid trading periods. So the strategy isn't being very efficient. Thank you very much. That was the RSI indicator with Martingale position sizing, and we used it to demonstrate that we could beat the market, although we achieved lower Sharpe ratio because of the intense volatility. You can clone this strategy inside QuantConnect and backtest it over 15 years of financial data. Cheers.